Here's the reality. We have 25 days to avert economic catastrophe. Catastrophe is what will happen.
Tucker Carlson warns we have just 25 days left. Jim Cramer's tweets of death strike again, and yikes, the mainstream media is once again peddling fear, uncertainty, and doubt. That the global elite seems to be sending you messages to continue to be fearful, to continue to move to cash, because how dare you start acquiring assets and trying to build your wealth? You need more fear. And now we've found an element of fear that hasn't happened since the Great Depression. And guess what? If the media has it their way, you'll run to your friends and family and warn them about this chart and what just happened, which hasn't happened in the last 90 years. Of course, my goal is to give you perspective on everything that is useful to your money now. And that includes what the heck happened to Tucker Carlson's 25-day warning. We'll talk about Jim Cramer's tweet of death in First Republic Bank. Oh my Lord. Then we're going to talk about this depression issue. We'll also talk about what generation of investors were the greatest paper handlers in a study conducted. We'll also look at a critical data set that you should be prepared for Thursday and Friday, 2 critical data sets. And we'll uncover not only the answers to this, but as a thank you for liking the video and hopefully subscribing if I've earned it, I will show you a picture of Cathie Wood replying to me. First, Jim. On March 10th, Jim tweeted, "First Republic is new focus. Very good bank." Well, you know what that means. Not Jim Cramer loaded up the shorts as soon as Jim Cramer tweeted that First Republic is a very good bank. And sure enough, the stock fell from approximately $90 per share all the way down to under $13 per share when Jim Cramer tweeted, "The First Republic torture will continue at its regularly scheduled 9:30 a.m. And then, of course, as if on cue, First Republic Bank started rising again, only to fall another 50% yesterday, now down to even lower than where Jim Cramer warned about the dangers coming. And First Republic Bank is now sitting at just about $7 per share. And a lot of folks are worried that this company, which just lost about 40% of its deposits and has 10 times more debts than it has deposits, is next to go bankrupt. That is leading First Republic Bank to consider a $100 billion asset sale, so that way they could sell off notes and securities. Problem is, now they have to be marked to market, right? Nobody's going to pay market value for old loans that are worth less now because rates have gone up, and they're probably going to have to take some big L's. But it'll actually raise cash, which would be useful for potentially saving the bank. But right now, things aren't looking good, and if you just bet on the opposite of what Jim Cramer does, well, you'll be part of the Inverse Cramer Club, who are having a field day. Now, we've got to talk about Tucker Carlson and the 25-day warning, which there are plenty of memes circulating that on Friday, Jim Cramer said Tucker Carlson is great and has a great show, and sure enough, on Monday, Tucker Carlson was fired. But that was just a joke. That didn't actually happen. However, what is this 25-day warning? And then what is the depression issue? And then who's the biggest generation of paper handlers? What did Cathie Wood say? Let's continue after the 25-day warning.
Here's the reality. We have 25 days to avert economic catastrophe. Catastrophe is what will happen if we run out of diesel fuel.
Yes. Remember the 25-day warning. This is from the diesel crisis. And I'm bringing this up because, well, first of all, what did I say about the diesel crisis? Yes, prices might go up a little bit, but is this really a big deal? And are we going to run out of diesel?
Will we actually run out? Probably not.
Well, that's what happened. As usual, things just weren't as bad as feared. And I have to tell you, this is the story of life. When I find that I'm going on a vacation, for example, I always find that life always follows you. Your vacation will never be as great as you expect. Well, maybe sometimes it exceeds expectations, but oftentimes things don't go perfectly as planned, right? Just like life, 2 steps forward, 1 step back. And just like the fears that we have, usually don't end up being as bad as we expect. Now, don't get me wrong, I've got a lot of fears as well. I had fears when I was a child and I lost my child at home, or when my parents were going through divorce and I had to live in a motel for months. I was fearful then, or I've been fearful of my adult career. But I'll tell you, the diesel crisis and maybe some of the other things that we're going to address sometimes just don't turn out as bad as feared. Think about the diesel crisis. Everybody was worried the world was going to run out of diesel because we weren't going to have enough diesel to warm the countries in Europe, and we were going to run out of diesel, which is so important for trucking in America, and the world was going to come to a harsh stop, and we were going to be in a Great Depression. Well, as Elon Musk says, fate loves irony, and what ended up happening? Literally the opposite. We are literally in a situation now where diesel is down 50% from last year's record. Even though gasoline is trending up a little bit, it's fallen a lot as well. But diesel is plummeting. One of the reasons is, according to JB Hunt, a transporter, we are in a, quote, freight recession. The winter was a lot warmer, and which is weird because California had record snowfall because they had a lot of rain, but that didn't necessarily make the winter warmer or colder in Europe. We had a warm winter. Overall, we had a relatively warm winter. Now you got Californians freaking out because we're about to get a heat wave, and that's going to melt so much snow so rapidly, California is going to have, again, too much water. It's always too much or too little in California. But focusing on this diesel issue, look, OPEC Plus just massively cut crude oil production, and usually that sends oil up, gas up, and diesel up, usually. And it did when they first announced their cuts. Yet, what's happening now? Well, unsurprisingly, oil and Brent are, that is WTI, the Western blend, and Brent, the international blend, are basically back to where the levels were before the OPEC production cut. And diesel is plummeting. Why is that happening? Well, a lot of folks are worried about the Fed cooling the economy so much so that manufacturing activity is contracting and slowing down. ISMs and S&P surveys are just not looking that great. Warehouses are generally overstocked from the pandemic. And we've had massive plummets in imports. Just look at UPS. They had their first revenue dip since 2009 this week, and their stock fell about 10%. Companies have also been less accurate in predicting their freight needs, which is a sign that companies that were saying, hey, yeah, we should have some good freight orders coming, are going, just kidding, we don't need those freight orders anymore. And what is that doing? Well, it's screwing the truckers. My heart goes out to the truckers. That's actually a hard-ass job, and you're alone a lot. My heart goes out to you. And now what do we hear? Well, you've got Bob Costello of the American Trucking Association. He's a chief economist there. He says that trucking companies are seeing their fleets in the size of around 200 to 300 trucks failing at a rate of 1 per week. One trucking company going bankrupt per week. This is also bad for trucking companies and individuals, not just like JB Hunt, but also people making bets on this trucking transformation with companies like Nikola or Hyliion. So beware. Okay, but what about this Great Depression thing? And I do want to also just quickly mention, hey, this was not to bag on Tucker, and I'm not a Tucker apologist by any means, okay? I'll call out Tucker, but, you know, I don't think people should be fired, so we'll see what happens with that. But I want to be clear regarding Tucker. It's not just Tucker who was talking about this diesel crisis. Everybody talked about the diesel crisis. It was trending for a very long time. It's just useful for you to see how things weren't as bad as feared. And that's going to be quite useful when we analyze this Great Depression, fear-mongering that's circulating on the internet right now. It's going viral on Twitter. It's going viral on YouTube. We just have to be honest about it. As a quick side note, solely because it's funny, did you know that Tucker Carlson and Don Lemon hired the same attorney to defend them? That's true. Brian Friedman, a famous Hollywood lawyer who's negotiated multi-million-dollar settlements for people like, well, actually, he's still working on negotiating Chris Cuomo's. He's looking for a $125 million wrongful termination payout, but also secured payouts for Megyn Kelly, Julia Roberts, Mariah Carey, Seth Rogen, Quentin Tarantino. He's worked for all of these folks, even Chris Harrison from The Bachelor and Michael Jackson's estate. Okay, sorry, tangent. But what about the Great Depression? Yes. Okay. So what's happening? Well, I'm going to try to make this as simple as possible because it can get complicated, but I trust that you are with me in wanting to get to the bottom of this. So what's happening is everybody's freaking out about the money supply expansion having turned negative. And people call this a massive economic warning. They say the money supply hasn't contracted in 90 years. In fact, other periods that the money supply has contracted, Nick, I'm borrowing your chart. Dude, I appreciate you. I respect your opinion. I think you're wrong about this one, but that's okay. We could still have coffee or beer together. I don't know, maybe not beer. We'll figure it out. We could still hang out, okay? I still respect you, man. But Nick here on Twitter says the money supply has contracted in the Great Depression, 1929, the Depression of 1921, the Panic of 1893, and the 1870s banking crisis. And in other words, Nick says, what amazes me is that nobody is paying attention to this. And now we are about to see a massive amount of economic pain because the only time this happens is during periods of massive economic pain. Well, what the hell is actually happening here? Well, to some extent, Nick could be correct. Maybe this is going to cause a massive economic depression. However, there are some reasonable explanations for why this is happening. The first is something known as a return to trend, okay? Here is the money supply expansion. Remember the global elite, central banks, they're always printing money to make your cash worth less. I'm not defending the government. I'm not an apologist for the government. They are making your cash worth less, so they have to pay you less money, and so your wages are worth less. This is why real income is basically negative for every income bracket. It's part of the game. It's how debt gets paid off easier and how capitalists make more money. But guess what? When you understand the game, you invest in things like stocks and real estate and businesses, and then you learn to play the game, and then you also get wealthy. That's my goal. That's my goal of what to teach you on this channel. It's very important. But if we have a return to trend, that means we're either above or below trend, right? Well, are we above or below it? Let's look at the chart. Oh, we are well above a 2020, or sorry, I should say a 2000 to 2019-ish level of trend. And so returning to trend means, of course, the number is going to go negative. So number one, return to trend. That's a normalization. Number two, base effects. The chart that Nick showed you and that other folks are showing you on the internet is a percent change chart. Of course, when the Federal Reserve is printing $80 billion per month, when inflation is 6 to 7%, like they did in March of 2022, which is insane that they were printing money as little as 13 months ago, well, what happens? When you stop and all of a sudden you print just one less dollar or you take $1 out of circulation, surprise, surprise, of course you're going to go negative. Duh. That's how the math works. We have not expanded the money supply this rapidly, hint, ever. Think about that. We have never expanded the money supply as rapidly as we did during COVID. In fact, take a look at this chart here. And what I want you to see is that the blue line that goes up and down, it's pretty volatile. The blue line that goes up generally goes up and down around a trend. And so when you see between 1965 and 1985, it goes up around a trend. You get a down there around the 1990s, and then you get this slight increase from 2000 to 2020, end of 2019. That is very normal. And because, again, the global elite is printing money to make your money worth less. We know that. That is normal. Again, not justifying it. That's just what happens. But what does it actually mean? Like, when does the expanding money supply create inflation? Well, if you look at 2000 to 2019, the money supply, as long as it expands at a relatively trend level, hint, hint, it does not create inflation. You driving at 50 miles per hour and running the money printer at the same rate of speed does not create inflation. Even though people say when you print money, you create inflation, that is not what happened between 2000 and 2019. Yes, we had like 1.5% inflation. That's nominal. That's not runaway inflation, right? What does create inflation? Well, using the car analogy, when you step on the gas and all of a sudden you're going 130 miles an hour because you're driving Tesla Model S Plaid on the freeway and you're trying to get away from a stalker, well, now you're going to create some problems. And in the economy, that problem is inflation. If you slam on the brakes and the rate of change is rapid, you could also expect rapid disinflation. Okay, so now go back to this chart. What I noticed is I identified 3 periods of time with an orange arrow where the money supply expanded rapidly out of a recession. Now, out of a recession is important because if it's expanding in a recession, You don't necessarily have inflation because the economy is contracting. But out of a recession, you had an expansion in 1972, 1976, and 2021. And what happened with an average lag of 16 months thereafter? Well, you guessed it. You had rapid inflation, which you could see here based on the red chart. 23 months later after the 72, 74 era. In fact, I put a little chart over here. 23 months after the money printing downtrend begins in 1973, you have an inflation peak 23 months later. After the money printing downtrend begins in 1977, it takes 38 months for you to actually hit peak inflation. And then in February of 2021, it took about 16 months for us to hit peak inflation, assuming that we've already hit peak inflation. Now, generally, peak inflation matched a recession. That's scary because after you hit peak inflation, you actually were in a recession. People realized after the fact, oh, damn, when we hit peak inflation, we were in a recession. Oh, crap. Well, wait a second. What did we actually have in the second quarter of 2022 when we hit peak inflation? Negative GDP. We were technically in a recession when we hit peak inflation. Oh my God, look at that. Now, does that necessarily mean we have a Great Depression ahead of us? Well, the one scenario where the answer is possibly would be 1982. But notice the money supply didn't really rapidly expand in 1982. It did a little bit after the recession, printing out of the recession. But what you had was a de-anchoring of inflation expectations. And this is where I can warn you about what's happening tomorrow. But let me first just give you a quick summary so we can put this money supply issue to bed, okay? So, quick summary on money supply. Normalization, return to trend makes sense. Base effects, makes sense that we're going negative. And number two, what you want to look at for the math nerds, okay? That's why I'm going to keep this really, really short. Number three, now I'm going to keep this really, really short and put it in sort of a little summary segment here. You need to see a rapid expansion of the money supply at a rate of growth that is higher than trend outside of a recession, and then you get massive inflation. In other words, it's the first derivative. It is the acceleration, the rate of change of the rate of change, right? When you do that, you can see that the positive rate of change or the acceleration of money printing, in other words, when you speed up how quickly you're printing money, that tends to lead to inflation with a lag of about an average of about 17, 18 months. It's exactly what we saw this time. So this is completely normal. For three reasons, it's normal. It would be expected. In fact, if you just went back 2 years ago, the Fed should have seen this coming. Why didn't they? Because the Fed doesn't actually pay attention to the money supply as a tool for measuring inflation. They prefer the the CPI report. Well, technically they prefer the PCE, but who cares? Same crap. Okay, so what do we want to pay attention to tomorrow? Who's the biggest paper hander? What happened with Cathie Wood? Come on, man. Kevin, you're leaving us hanging here. First, tomorrow, we are going to get GDP numbers. Now, this is important because the GDP numbers are going to be indicative of, do we think we might be trending towards a recession? We are going to get a quarter-over-quarter GDP growth number, and then that is going to be multiplied by 4 to get an annualized GDP number. Please don't use exponents. I'm not doing a math lesson. It is a simple multiplication number. Don't overcomplicate it. If we get a 0.5, the survey says, which is what the survey says, we should look at an annualized GDP of 2%. The prior read was 2.6%. If we get a big miss on GDP, the stock market's going to lose their poopy doopies, and they're going to have diarrhea because they're going to be worried that we're going into a recession. If the number comes in hot, it means higher for longer from the Fed. So, as usual, maybe you want something close to estimate or a little bit soft, but not mega soft. You get a big miss, it's going to be a problem. Next, inflation expectations. You don't want another Paul Volcker of 1982. We've talked about this plenty of times before, but tomorrow, you're not only going to get the PCE release for the Federal Reserve, but you will also be getting those University of Michigan one-year inflation expectations, which did de-anchor. That comes out on Friday. That's going to be very important. Now, what other news do we have? Well, first, I'd like to say which generation is the biggest paper hander? Well, congratulations. Millennials are the biggest paper handers. Not only are millennials the biggest paper handers, but they are the perfect example of apparently the group of individuals who have to learn this lesson on screen now. That investors pay a steep price for missing the best days of a rally. Here's the performance of $10,000 invested into the S&P 500 over 20 years, ending 2022. And if you were fully invested, that $10,000 turned into about $65,000. If you missed the 10 best days, you had half as much money. Missed the 20 best days, $18,000. 30 best days, $11,000. You get the idea. Then you start going negative. You be careful. One thing I've learned, massive patience over this last cycle, and it's not just timing the market once, it's getting back in. Oh boy. And I hate to say it, but I'm your poster boy of a millennial. So next, I think they're going to start doing surveys of flip-floppers. The good news is I'm heavily invested. I am very, very excited about our economy and what's to come in the future. And I'm a big believer in the sort of elongated Nike swoosh over this next decade. I believe wholeheartedly that in 2030, we're going to look back and go, damn, those were some really good deals. Glad I bought. No guarantees. Now, what else do we have to talk about? Let's talk about Cathie Wood. All right. So Cathie Wood indicated that she was concerned that 3M, the industrial manufacturer, the one that used to make a lot of masks and stuff, the industrial manufacturer provided negative growth to their revenues. And Cathie Wood argues that she is, or looking at 3M, can usually be an indicator that the economy is going into recession. And Elon Musk replied to Cathie Wood and suggested, are they simply looking at old data or are they ignoring the bad data that they have? Cathie Wood replied and said they're ignoring the bad data. And this is a big problem, that when 3M comes in with such negative numbers, it's a bad omen for the economy. So I responded and said, hey, Cathie Wood, how would you say Nestle works, now this is a Swiss company, in a leading indicator scenario versus 3M? Their Q1 price growth below spooked me a bit this morning, and I'm in camp disinflation. But remember, I don't just tell you what reiterates my thesis. I'm going to go, oh crap, when I see something, okay? I did not like that McDonald's has massive PP in their franchises. Again, they raised prices on their franchisees, yeah, the people running the franchises. And McDonald's has pricing power over those franchises. They expanded revenues at like 10% and they grew their margins. It's great. But they don't on the food side. They actually had negative pricing power on the actual restaurants that they operate. But anyway, back to Nestle here. So my initial thought was this represents likely volatile food categories. But then again, if they're able to raise prices because food prices are going up, why are milk prices down 9% and other food prices down? And so Cathie Wood replied. She replied me, and I felt honored. Anyway, so Cathie Wood replied and said, look at the volume declines. The consumer is railing against higher prices. I have never seen declines of this magnitude in unit volumes of staples. In short, this is a short-sighted strategy to bolster margins, and it will backfire to the benefit of generics and store brands. Okay, a lot to unpack there because it was actually a phenomenal observation. So I responded, great point. I revisited the table and focused on this specific number that is known as real internal growth. Look at that chart on screen here. This paints a different picture. Real internal growth is basically saying, hey, how much, when we take out inflation, did our sales actually go up? And in many categories, they're actually negative rather than positive. So now all of a sudden, I write here, in other words, even though the company feels like they won because their pricing was slightly greater than their volume decline, temporarily rewarding shareholders, consumers are reducing volume. And if competitors reduce volume, or reduce price, that is, if other competitors are like, oh, our volumes are going down, let's reduce price to compete, like store brands and generics, Nestle will be forced to lower their prices or end up suffering from a loss of market share. Now, I don't think this is like a smoking gun that says, oh my gosh, short this company. But I do think it is an indicator that maybe, once again, when we first look at data that says, oh, all the headlines, Financial Times or whatever, Nestle's raising prices, they have all this pricing power. We actually look at the details, it's like, well, their volumes are going negative in a lot of categories. And It's maybe a red flag that we could see some temporary leftover inflation, but we're still mostly on the trend of disinflation. Now, this is bullish, right? Well, not according to the Wall Street Journal. See, apparently quants are out of buying power. $170 billion of global shares have been loaded up in the last 30 days, the highest level since early 2022, and now positioning is near a peak. And unfortunately, quants may become sellers if we continue to downtrend. Yikes. So, are we in a slowing economy? Well, certainly. If you look at Google, we are in a slowing economy. Not only did Google, and Google did decently, they beat on EPS. Now, some of that was due to some fancy accounting tricks. We're talking about that in the course member live stream, as well as Microsoft. We're going through their earnings in detail. But what's something that's very important when you look at the Google earnings report, and I'm not trying to be a Google bear here. I love Google. I use Google Cloud. I have friends that work at Google. I actually think they're a phenomenal company. The problem is 68.6% of their revenue comes from simply Google search and Google network. Google network is falling 8%. Google search is only rising 2%. And I don't think that Google is taking AI and how it's going to disrupt search as seriously as Microsoft is. Microsoft actually rallied because they're talking about multi-billions of dollars of opportunity if they get AI right. They are being serious about AI. They are being smart. I think Google needs to get serious because 68.6% of their revenue is on the line. So buckle up, my friends. We are going to go through a transition. And no, I don't mean a Bud Light style transition. I just mean things are going to change. Now, do I really think that we need to be extremely fearful? And if you find this inspiring, I really encourage you to share this video. Like the video, subscribe. Let me know what you think in the comments down below. I've been reading the comments. I really appreciate your support. This fear, is it founded? Well, things just aren't actually that bad, in my opinion, in terms of broad economic data. Could it turn bad? Of course. Things could get a lot worse. Maybe we're looking at information that is lagging, and maybe things are worse than they appear. But there's one thing that I can tell you. Whether things are worse than they appear or better than they appear, as long as you're alive, knock on wood, you're healthy, and you can invest in yourself to make yourself more productive, whether you take courses to educate yourself, you read books, you try to be a little bit more efficient every single day. When you travel, you pack your bag a little bit better so that you don't keep missing stuff when you go travel. I do the same thing too. I'm trying to get better every single time I do something. And that's important. People make fun of me sometimes. They're like, oh, Kevin's changing his mind again. Yeah, I change my mind when there is a better tool, when there's something that provides better value to the customer, better value to my team, better value to myself and my family. I will always change my mind, and you should too. And I will always promise to do the same thing with the companies that I operate. For example, my real estate startup, House Hack. I will guarantee you one thing. I will always flip-flop to what I think is the most profitable strategy. And that is exactly what shareholders hire executives to do. And this is why I think Google needs to quickly flip-flop. Anyway, thank you so much for watching this. Please stay strong, be inspired, invest in yourself, and you'll get ahead of all of the drama. Thanks so much, and we'll see you soon.